Okay, folks. I don't think I need to even ask you the question. You kind of know what the question is, right? If you haven't picked a company. We're moving on right here. I'm going to start the class off by asking you a few questions about implied equity risk premium, just to get a sense of whether you understand the dynamics of what caused it to change. I don't know how many of you had a chance to open up that Excel spreadsheet that I used to get the implied premium at the start of February. Even if you didn't, you should be able to deal with the questions that come up. So how do I compute the implied premium? I take the level of the index. I take the base year cash flows, last 12 months. I put a growth rate on those cash flows. Then I solve for an internal rate of return. And then I compare that to your risk-free rate to come up with an implied premium, right? So at the start of this month, it was 5.56%. So I'm going to go through item by item, and as I tell you the direction of that item moving, I would like you to at least guess which direction the premium. So you don't have to give me a number, just tell me. So holding all else constant, if the S&P 500 goes up, what's going to happen to the implied premium? Is it going to go down, go up, or remain unchanged? Let's say the index jumps 10%, holding all else constant. It'll go down or go up? Go down, okay. Does everybody agree with that? Give me the intuition as to why it goes down. No, don't do mathematics. Give me the intuitive explanation of why as stocks are higher, you're earning a lower premium. Because you're paying more for stocks up front, right? Why, if you pay more up front, is your premium lower? When you pay more for something up front, your expected returns have to be lower, right? Because you're paying a higher price for the same cash flows. You pay a higher price, your expected return is going to come down. If your expected return comes down, it actually is almost, you think, but this is good, right? Stocks are going up. You're right. If stocks are going up, it means basically your risk premium is going down. You're accepting a lower risk premium. If stocks go down, holding all else constant, that's why in crises, risk premiums rise. Because stock prices collapse, risk premiums go up. So if stocks go up 10%, holding all else constant, the risk premium is going to go down. So let's go back and leave the index where it is. Let's turn to cash flows. Let's assume we hold only, because if you think about it, the 12-month cash flows that I used buybacks, and a big chunk of the cash flows were buybacks. And there's talk about this year buybacks are going to be even higher than they were last year, because there's a lot of trapped cash coming through. Let's assume that I hold the level of the index constant and I increase my cash flows. What happens to my risk premium now? Same price, higher cash flows. The risk premium is going to go up. Do you see why? Same price, I get higher cash flows, I'm going to get a higher return. Let's say I raise both the index and the cash flows by 10%. Hang in there, there's a reason I'm taking you on this expedition. If the cash flows and the index go up 10%, my risk premium is going to stay pretty much unchanged. Now do you see why risk premiums go up or down over time? It's not that stocks are going up, or that it's that one is going up more than the other. If stocks are going up more than cash flows, then risk premiums are going to go down. If stocks are going up less than, that's why over the last 10 years we've seen stock prices rise, but risk premiums haven't dropped. Why? Because cash flows have gone up even more. That's often what people miss when they focus just on prices. They say, but stocks are up so much, we must be earning a lower return, right? That depends on what's happening to cash flows. That doesn't mean it'll continue. So when you think about risk premiums, keep your eye on stocks, keep your eye on cash flows, but also keep your eye on the risk-free rate. Where does the risk-free rate enter into this process? It enters in two places. Let's see what the first place is. When I do my cash flows at the end of year 5, what do? I let the cash flows continue to grow at the risk-free rate. So if risk-free rates are low, your cash flows after year 5 are also going to grow at a low rate, because low risk-free rates are an indication that you have low inflation and low real growth, and I'm building that in. So when I raise my risk-free rate, holding all else constant, I'm going to get a higher growth rate after year 5, and holding all that will push up my expected return. But now I'm subtracting out the risk-free rate from that expected return. The risk premium effect when risk-free rates go up is actually unpredictable. It depends on how much the growth effect dominates that subtracting effect. The biggest reason risk premiums have gone to levels we haven't seen, if you remember that graph that I showed you, 1960s, 1970s, 1980s, 1990s, and then you get past 2008, you see much higher risk premiums. The biggest reason risk premiums are higher now than they were 10 years ago, 15 years ago, 20 years ago, is not because we're earning more on stocks. It's because the risk-free rate has dropped off. The premium we're earning over the risk-free rate has gone up to 5.5 or 6% because we have lower risk-free rates. And that, again, is something that's worth watching. Will risk-free rates go back to 3.5 or 4%? And if so, what happens to stocks then? So if you get a chance, take that spreadsheet and play with it. Change the number, right? Change the index to what it is today. Change the risk-free rate. Change the growth rate. See if you can get a sense of what it is that causes that risk premium to move, because that risk premium is going to come into play. So I've been preaching this gospel now for 25 years that we should be using a forward-looking dynamic number rather than a historic premium. For most of those 25 years, I was ignored because the way you do things is a historical premium. Why mess with a good thing? We have a number, and yet services that provided these numbers. It used to be a service called Ibbotson Associates. Now it's Duff and Phelps. It allows you to pass off the blame. I'm using somebody else's risk premium. But one other argument I would hear, and this is something I'd like you to tell me whether it makes sense, is I'd go into an investment bank and I say, look, you should be using an implied premium. And the managing director would say, hey, don't make a big deal about this. We might be using the wrong number, but we all use the same wrong number. So let's see how this plays out. We're using historical premiums. The 7.93% is the arithmetic average. A lot of people still use arithmetic averages, don't ask me why, and some use over T-bills, but 7.93% is a premium. We all, every single analyst in this house uses 7.93%. So as long as we use the same risk premium, it should be okay, right? So here's my question for you. The implied premium right now is let's say 5.96% at the start of the year. People are using 7.93%. You have 20 analysts, each valuing stocks using 7.93% premium. If they're doing intrinsic valuation right, what should you expect them to find? A lot of overvalued stocks, a lot of undervalued stocks. Try again. Basically, use too high a premium. What's going to happen? You're going to come up with lower values for every stock, and stock after stock, you're going to look and say, terrible investment, terrible investment, terrible investment, don't buy, sell, 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 sell. And it's not because you don't like the company, but because you have a point of view about the market. One of the things I'd like to emphasize as we go through this class is when you want to value a company, I want you to value the company. I don't want to bring in your views about the market, your views about the economy, your views about GDP growth. This is not the place to bring them in. And if you bring in a risk premium that's very different from the current implied premium, whether you like it or not, you're building in a view about the market into every single valuation. So if you use a 3% equity risk premium and the actual premium is 5.96%, what are you going to find? Everything you look at is going to look cheap to you. Because you're building in a presumption with that 3% premium that the S&P 500 should be 40% higher than it is today. If you truly believe that, what the heck are you doing even buying stocks? Just buy the entire index and you're going to make your money. So the reason I care about the implied premium is if you use a number, I'm going to check your number against that number and say, hey, you know what, you found the stock to be undervalued, but are you sure you like the stock, or are you telling me something about the overall market? So don't let the defense of we're all using the same number, therefore it's okay, become a shield against coming up with a premium. I'm not saying the right premium, but somewhere close, within shouting distance of what the premium is in the market right now. Any questions? So I have this very long paper I do on equity risk premiums that I've been updating every year since 2008, because this is an obsession for me. And at the end of the paper, I present historical premiums, I do implied premiums, I do that bond default spread times 2 because it's roughly so I take these competing ways of estimating equity risk premiums. So after I present them all, at the end I say, look, our end game is not to theoretically show that one premium is better than the other. It's to come up with a premium that's the best predictor of future returns, right? Because that's the end game. You want to come up with an estimate of the equity risk premium that best captures what stocks will do in the future, because that's what you want to build in. So at the end of the paper, I said, look, I have 6 different approaches, and I won't blame you. You said, well, you've given me 6. Why can't I pick one of the 6? Let's see which of these 6 does the best job of predicting what stock returns actually do next year, the next 5 years, next 10 years. So what you see here actually are 4 competing measures for the implied premium, for the equity risk premium. One is the current implied premium, which I update every month. The second is a smoothed out version of that number, where I take the average over the last 5 years, basically to get a sense of, hey, maybe numbers jump around, maybe I should use an average. Then there's a historical premium, which everybody uses. And then I take that default spread, and given history, it's about 2 times the default spread. I use that. And then I look to see which of these numbers. So you want a high positive correlation, right, if you want a good predictor. So if you look across the implied premium next year, it's no contest, right? Basically, the implied premiums do a very good job of forecasting next year. And you say that's unfair because you're computing the implied premium. Maybe there's something in the process. Take it. If I take the correlation with the actual returns over the next 5 years, now we're looking at actual numbers. It turns out that the highest correlation, again, is with the implied premiums. And look at the historical premium. What does that negative number tell you? When the historical premium today is high because of the past, your actual returns on stocks in the future are actually going to be low. So the historical premium, you can use any premium you want as long as it's not the historical premium, right? It's a negative number. And this is how 90% of expected returns are being computed when people use the CAPM. And then they blame the CAPM for things not working out, when the flaw might be in the way risk premiums are computed. In fact, you don't like my implied premiums? Just take the BAA default spread, multiply by 2. It's better than a historical premium. Right now, the BAA default spread is about 2.5%. 2.5% times 2 is 5%. Use that as your equity risk premium. If you don't like you think it's too complex, the solver function is just over your head, just let it go. Just don't use the historical premium. That said, I'll guarantee you, when you get on your desk and you're doing an evaluation or corporate finance, people are going to be using historical premiums around you. Just let it go. You're not going to change the world. Just scream to yourself as softly as you can, the silent scream, and say, okay, that's what you want me to do, but remember, every time you use a historical premium, you're in a sense fighting the data. Any questions on the choices? Now, one other advantage of an implied premium that I haven't exploited fully is, remember how I came up with country risk premiums? It was pretty contrived, right? I started with the US premium, then I took the default spread, then I did the scaling up. There's a lot of gymnastics I had to do to get to that final number. And I'm not particularly happy about the way I got there, but desperation drove me there. There is another way of computing implied equity risk premiums that I would love to do, but the data is still not quite there, but let me take you through the process. Let's assume you ask me what the equity risk premium for India is. Right now, the way I've described it, I'm going to do the implied premium for the US, then look up the default spread for India and do a scaling up and then add it in. But what if I did something different? What if I computed an implied equity risk premium for India? You're saying, but it doesn't have any history. I don't need any history. What's the data I need? I need the level of the index today, which I should be able to get for any index. I should be able to get cash flows in the most recent 12 months, which basically I can get by adding up the dividends. And many countries, it's actually easier than the US because it's just dividends. You don't even have the buybacks. I need an expected growth for the next 5 years, and that is where I run into problems when I look at markets outside the US. In the US, it's almost routine to do 5-year projections. They're sloppy, they're not particularly well done, but people do them. Outside the US, it's the exception rather than the rule. It's starting to change. But if I try to do this for the Sensex, which is what I tried to do, for instance, this was in 2007, I took the level of the index, 15,446 at that point in time. I looked at the dividend yield on the index, which is about 3.05%. There were no buybacks at all in 2006. I was just able to use dividends. For the expected growth rate, I cheated. The way I got it is I found ADRs. You know what ADRs are? These are Indian companies listed in the US where I could get a forward growth rate. I couldn't get that. So that's a very small subset of the Sensex. I took only those companies, took their growth rate. So you can see already that this is the weakest link in this process. I took that 14% growth rate. I set the risk-free rate equal to, so in this case, everything is being done in nominal rupees. So the risk-free rate is a nominal rupee risk-free rate. The growth rate after year 5 is a nominal rupee growth rate. And I did exactly what I did for the S&P 500. And what I got as my internal rate of return, solving for that equation, was 11.18%. You're saying, what do I do with this? I subtract out the risk-free rate in rupees, 6.76%. I get an implied equity risk premium for India in 2007 of 4.42%. And I'll tell you why, especially with India and China. This is a number that is worth computing. When we talk that approach where I have equity risk premiums for the globe, where I start with the US and I kind of scale across, is built on the presumption that money can move out of markets if the equity risk premium gets too low. So if the German equity risk premium gets too low, people will leave the German stocks and go into French stocks or US stocks. But that's built on capital flowing in and out of markets. Now do you see why in India and China that is a dangerous assumption? Domestic investors are still restricted, not as much as they used to be, but still restricted in whether they can take money out of the Indian market and take it to another market. So what does that mean? You could end up with Indian stocks and Chinese stocks reaching levels where you look at the equity risk premium and say, this is too low. But since you can't take your money to another market, you're kind of stuck with that premium. I think it's a dangerous place for a market to be, because you want a market where capital is there voluntarily. But right now, a lot of capital invested in markets that are closed is there because they can't leave. That's why the Chinese have struggled with this for the last 10 years, is they open up the escape doors a little, then they close it really fast, because there's going to be volatility, there's going to be money flowing out of the market. But that will effectively mean that the implied equity risk premiums in these markets can be far lower than a mature market premium. In fact, in 2007, the Indian equity risk premium was lower than the equity risk premium in the US, which raises an interesting question of, if I had a choice of investing across the globe, why would I invest in the Indian? Doesn't mean I would not buy any Indian stock, but you can see collectively investing in Indian equities becomes tricky if the risk premium drops below. So if you have markets that are closed because of capital constraints, you might want to look at the implied premium to see what it looks like. Okay? Because one of the problems, though, is even though Indians might not be able to take their money out of India, what happens is if the premium in the equity market gets too low, guess what Indians do? They sell stocks and they move it to some other, it's like a moving bubble in the country. It moves to real estate, then it moves to some, because you have no choice, it's desperation. You know that stocks are not delivering a high enough return, but I'm not giving you the escape hatch, which will let you go into a different market where you get a better trade-off for risk. So any questions on implied premium? So this is something I'm tracking, because one of the things that's happening is more and more companies, even in emerging markets, I can now get forward growth rates. And as that improves, one of these days I might be able to compute implied equity risk premiums for 160 countries at the start of every month. There is zero chance I'm going to do 160, but maybe I can do 6. I can pick the US, I can pick India, I can pick Brazil, I can pick China, maybe at least a sense of what a regional number is by picking the largest markets in that region. Yes?
So in calculating the equity risk if I want to, the majority of the cash is from the stock buyback.
Yeah.
So by building future cash flows on the current level of buyback, you're assuming the buyback level right now is sustainable.
Well, that's why, in fact, when you look at the spreadsheet, I ask you what the buybacks and I keep track of what buybacks and dividends are as a percentage of earnings. In 2016, for instance, that number was 103%, and it freaked the heck out of me. Why? Because you can't keep returning more cash than your earnings and expect to grow at the same time. But that number is now down to 88%, which is pretty close to what the average has been for the last 15 years. But I also, when I get to steady state, ask how much will I have to reinvest to maintain that 2.5% growth rate forever. So it is true that buybacks are much more volatile than dividends, because companies, once they pay dividends, tend to pay them. Buybacks, they might decide to cut back. So 2009 was the only exception in the last 20 years where you did see a dramatic drop in buybacks. But but they bounced back by 2011. I have a feeling, though, buybacks are here to stay. This is the way companies are going to return cash, not just in the US, but around the globe. So we have to start thinking about buybacks as flexible dividends. Okay. Any other questions? One more thing about implied premiums. In the Brazilian market, I've actually been computing the implied equity risk premium every year for the last few, simply to get a sense of, rather than build off default risk, what would the premium look like if I compute it? So the way to read this is the red part of the column is the US implied premium. The additional green is the extra risk premium I'm charging for investing in Brazilian equities based on the levels of stock prices. So take a look at that number. So I start in 2000, and you got Lula's election, so basically you can see the Brazil premium is twice the US premium, and then you go on this extended period where the Brazilian premium shrinks and shrinks. By the time you get to 2010, Brazil actually seemed to buy into its own pitch that it was now a developed market, because if you look at the implied premiums, they're actually pretty close. And this was not just Brazil. A lot of emerging markets in 2011 and 2012 were convinced that convergence was only a matter of time. Whether you were going to India or Brazil or wherever else, they said, you know what, we're all becoming one global market. And it sounded good, right? And then we discovered, especially in the last 5 years, notwithstanding the advances in emerging markets, there are still pockets of uncertainty there that you don't have in developed markets. And especially in Brazil, of course, those pockets of uncertainty have been exaggerated by political scandals and the coming apart at the seams of, of how the government is run. And that's showing up as much higher risk premiums. So in fact, if you think about implied premiums as forward-looking dynamic numbers, that's the other advantage you get, is you get a number that reflects what's going on in the market today, rather than looking at a rating and a default spread that might not reflect those issues. One final table, and this is a table that I should update, but until about 2 years ago, what I used to do with all of my data is compute an implied equity risk premium. So I divided the world into developed and emerging markets, which is tricky, right? Because, for instance, I had to decide if I take all EU countries and make them developed, then I'm making Greece into a developed market. So finally I just started drawing lines there. You know what, I'm going to make my rough judgment on developed and emerging markets. Then I compute an implied equity risk premium for all developed market companies and an implied premium for all emerging market companies. Just like thinking of expanding out the S&P 500. What you see in the last column is the differential implied premium between developed and emerging markets. And you see the story that I told about Brazil play out, right? If you look at that difference, by the time you get to 2012, that difference is almost zero. In fact, when I was teaching the class in 2013, people said, does this mean that there will be no emerging market issue from this day on? And in 2013, the way this showed up is P/E ratios for emerging markets and developed markets had converged. They were essentially looking like they were one market. That, of course, is expanded out, but here's the good news for emerging markets. It's expanded out, but it's not like it was 15 or 20 years ago, when the difference was, it was huge. And that's those shades of gray that came out in 2008, they're not going to go away. I think you're going to get a difference. The difference is going to be much smaller than it used to be, because it is true that on any given day, a developed market can behave like an emerging market today. And on any given day, an emerging market can behave like a developed market. There are things that they share in common that you're starting to see play out. So any questions at all about equity risk premiums? So in summarize, you do what everybody does and use a historical premium, but do so at your own risk. You can try to come up with an implied premium. It doesn't have to be the way I do it. You can come up with your own proxy for implied premium, but it has to be forward-looking and it has to be dynamic. And if you can expand that way of doing premiums to emerging markets, you now have a complete way of thinking about risk premiums across the globe. So now let's move on. So we've talked about risk-free rates and risk premiums, right? What's one number we haven't done? So if you think about this as the CAPM world, we've got the risk-free rate nailed down. We at least have a way of thinking about the equity risk premium. What's the one number we haven't talked about? We talked about beta. And so let me throw the question to you. When you did your corporate finance, foundations, any finance class, anywhere in your past, how do we estimate betas? What do? You run a regression of returns in the stock against returns in the market index, and the slope of the line is the beta, right? What a horrifically bad way to think about betas. You see why? Because it's now made into a statistical number. In fact, when I go into corporate finance departments, I often ask the question of, where do betas come from? Because people use them all the time. You know what the most common response is? They look at me like I have two heads there. Barra, Bloomberg. Because that's a reality. Once you start working, nobody goes and estimates a beta. You go look it up on a service. Of course, the services run these regressions, and the slope of the line is a beta. So I'm going to build up a case against regression betas in 4 pages, and I'm going to bury it. And then we're going to move on. Here are my problems with regression betas. First, if you remember your statistics, when you make an estimate, it comes with a standard error. This is a repeating theme you're going to notice in this class. Is in finance, we've had this bad habit of taking estimates and treating them as facts. We do that with historical premiums, and I talked about the standard error there. And we do the same thing with betas. You look up a Bloomberg beta, 1.33, we act like that is a fact. I'm going to show you the statistics behind Bloomberg's own betas, and you're going to see how much of a lie it is when you take that beta. Second, it is backward looking. Why? Because I need to run a regression. To run a regression, what do I need? I need returns in the stock. To get returns, I have to look backwards. I can't give you returns for the next 5 years. And third, if a company's business mix changes, GE's beta today is different than it was yesterday. Why? Did you read the news story this morning? GE is planning to sell off business. The day after it sells its business mix is going to be different. Its beta will change. This is more the rule than the exception. Every time companies go into new businesses, get out of old businesses, the beta changes. And if along the way, they also change the mix of debt and equity, which again is more the rule than the exception, a regression beta is not going to give you a beta for the future. So I said I'm going to show my case against regression betas in 4 pages. Here's the first one. Betas cannot be trusted when they look bad. You say, what do you mean look bad? This is a beta for GoPro. You know what GoPro does? It's basically cameras for oversharing, overactive people, basically, right? Because what do? They put a GoPro on their head, they go for a 4-hour hike, and they expect you to go along with them and be fascinated by what they see, right? And actually they put up YouTube videos, 4 hours of me on my hike, come along. You know? So, but for a while it was a really hot stock. Did its IPO, zoomed through the roof. So I valued GoPro on my blog maybe 3 years ago still, so you can go check out whether I got it right or wrong. I don't even remember anymore. Right? But I had to get a beta for GoPro. So initially I said, let me go see what Bloomberg gives me as a beta. And it gave me a beta. 1.403, third decimal point. Right? Actually, sorry, 1.604, third decimal point. I'll come back and talk about the adjusted beta, another useless number that Bloomberg puts up there. But before you get too excited about that 1.604, if you keep going down and look at this number, standard error of the beta, it's almost 0.50. So let me do some basic statistics. The regression beta is 1.60. The standard error is 0.50. What's the beta for? Even if you trust the regression, what's the regression telling you the beta for GoPro is? Plus or minus 2 standard errors, which means its true beta could be 0.6 or 2.6. The median standard error for a beta estimate in the US is about 0.2 to 0.25. Think about this. Next time somebody says the beta for a stock is 1.1 plus or minus 0.4 or 0.5 on either side. And it's not the regression's fault. You're saying, but what if I have a great looking regression? Then be even more careful. Here's the best beta page I've ever run. It was in early 2000. I was looking up a beta for Nokia. That is a great looking regression. Every point is on the line. The standard error is close to 0. If this were a statistics class, I'd get a gold medal, right? But think about why it's such a good looking regression. It's a regression of the returns on the stock against returns on a market index. So stock obviously is Nokia. But what's that index? When I first ran this regression, I didn't even know there was an index called the hex. I thought it was a witch's curse until I ran the regression. The hex is the Helsinki exchange. You're saying, what the heck is Bloomberg going to Helsinki for? Bloomberg is very parochial about the way it estimates betas. You go to Bloomberg, you look up the beta for a French stock, it's estimated against a CAC. You ask for a beta for a German stock, it's against a DAX. A UK stock, it's a FTSE. A US stock, it's against the S&P 500. An Indian stock against a Sensex. You're saying, so what? Well, I didn't know what was in the hex. So I took a look, and I wish I had not. I think in 2000, Nokia owned Finland. It was 80% of the index, 80%. So what do you have here? A regression of Nokia against Nokia, and what are you finding? The two move together a lot. Congratulations, let's move on. But here's the reason the beta doesn't make any sense. What is beta measured? The risk to the marginal investor in the stock, right? Now you're saying, how do I know who the marginal investor in Nokia is? It's easy. I went and looked at the top 17 stock orders in Nokia. Not a single one was Finnish. The biggest investor in 2000 in Nokia was Barclays for their index fund. Let me ask you a question. If you're Barclays and you're asking how risky is Nokia to me, do you measure risk of Nokia against the HEX, or do you measure it against the MSCI or some global index? You're going to measure it against what you have, right? A global index. And if I replace, the nice thing about a Bloomberg beta is you can actually change the index. So try this out. No, replace the local index with the global index. The MSCI is one of the choices. You get a beta that actually makes more sense, but what kind of standard error is it going to come with? It's going to a high standard error is not a bug in the model, it's a feature. Here's why. Most of the risk in an individual stock is firm-specific risk. If you get a high R squared for a company, something is off in your regression. So if you think you can make that R squared get better by just trying different indices, you're going down the wrong path. So you can't trust betas when they look noisy, you can't trust betas when they look good. That kind of doesn't leave a sweet spot in there much, you know. But let me dig the hole a little deeper before we bury it. When you run a regression for a beta in Bloomberg, I think the default is 2 years. You're taking 2 years of data, right? That's a lot of data. But what if your company had something unusual happen to it over those 2 years? Either something unusually good or unusually bad. I'll give you an example. But this was in 2016. I ran a beta regression for Valiant, the Canadian pharma company, which had gotten into a huge amount of trouble. Stock price had collapsed from $200 to about $20. Let me ask you a question. If you're an investor and the stock price has gone from 200 to 20, do you think the stock is a little risky? Does it seem a little risky to you? It seems a little risky to me. So I ran the regression, and the beta that I got for Valiant based on the regression was 0.36. How do I reconcile a stock that's imploding with a beta that's almost zero? What does beta measure again? How the stock moves with the market, right? So if I have a stock where calamity is unfolding on the stock, every day you wake up and the stock is down, no matter what the market is doing, guess what's going to happen? Your stock price might collapse. You might feel a lot of risk, but your beta is going to go towards zero. And if you take that beta and make that the beta in your valuation, you're asking for an immense amount of trouble. Because this might have been the beta for the last 2 years while the stock was collapsing, but now that it's $20, you have to rethink the way you think about risk. And this can cut the other way as well. If your stock is targeted in an acquisition and its stock price keeps going up, even for a 3 or 4 month period, it's amazing how quickly the beta can start to move towards zero if you have one big event during that period. It's one slice of history. Again, a statistical problem. In statistical thought, don't trust one slice of history. That's what you're doing when you run a regression. And finally, here's my final case, page against betas. What did we talk about in the very first or second class? We talked about bias, right? Let's assume we play a game. You guys want to come up with a really high value for a stock. You want to come up with a really low value. I'll leave you out of the game. You can be the deciders here. So when you go looking for a beta for your stock, remember you want a high value for your company. You want a low beta or a high beta? You want a low beta because to make it, and you of course want a high beta. You think, but beta is beta, is it? I took, in this case, Bombardier. Bombardier is a disaster-prone Canadian company that makes aircraft on the side. Right? It's got a lot of debt. It does all kinds of stupid things. Yeah? But if you ask me what the beta for Bombardier is, and I went to Bloomberg and looked it up, there are 2 betas I can look up. And that's just to start. I can run a regression of Bombardier against the TSC because it's a Canadian stock. But Bombardier also has an ADR listed in the US. And if you ask for a beta for the ADR, guess what Bloomberg does? It runs it against the S&P 500. You see? Big deal. Well, the betas I get are very different. I get a 1.704 when I run it against the S&P 500, and I get a 1.21 if I run it against a Canadian index. So which one are you guys going to latch on to? You're going to latch on to the 1.21 saying, and you show me the page. Not both pages, but the page. The Bloomberg beta, right? And you're going to use, and in fact, I'm just getting started. I've told people, you give me 30 minutes and access to a Bloomberg terminal and tell me what beta you want for your stock. And I will deliver a printed page with that number. Because what are the things you can change? You can change the index, you can change the starting point and the ending point. You can change daily, weekly, monthly. In fact, if you get a chance and you have access to a Bloomberg terminal that's free, sit there just changing the parameters. And you'll be amazed at how much the beta will change. Your beta will go from 0.5 to 2.2 as you play the numbers. And the point I'm trying to make is if you have a strong bias, you will find a way to take the number that best fits your story. So does it come through that I don't like regression betas? I find it frustrating when people just plug. You're saying, what about the adjusted beta? This is in fact, when I bring the equity research analysts, they say, but I use the adjusted beta from Bloomberg. To which your response should be, do you know what it's adjusted for? What's the answer to that? Absolutely nothing. I'm not kidding. The adjusted beta in all 4 of those regressions you saw was the regression beta, the raw beta, times 2/3, hang in there with me, plus 1/3 times 1. You're saying, what? So if your raw beta is 1.8, your adjusted beta will be 1.53. Track what's happening to the betas with each one. 1.8 will become 1.53. 1.5 will become 1.33. 1.2 will become 1.13. 0.6 will become 0.73. So you see what's happening to the betas? They're being pushed towards 1. What's so magical about 1? That's what happens to companies as they get more diversified and look more like them. Bloomberg is trying to be helpful. To which your response is, please stop. I still remember the first time I saw this, my response is, you could use any, why 2/3 and 1/3? Why not 0.8 and 0.2, 0.7 and 0.3? There are all these choices for weighting. Because that's the way they use for every single stock. All 40,000 stocks that they report betas for, the adjusted beta is 2/3, magic weights. So I was curious about where these numbers came from. It's about 16 or 17 years ago when I first saw these numbers. I decided to call Bloomberg, not the mayor, but the company. But maybe I should have called the mayor. Maybe I've got the answer more quickly. And they put me in touch with the beta calculation guy at Bloomberg. There is actually a guy at Bloomberg whose life it is to maintain this page. Imagine how exciting his life must be. He goes around to cocktail parties and says, I'm the beta guy at Bloomberg. Dozens of people gather around for anecdotes. Not. The guy's pathetically grateful to get a call from the outside world. I don't know what they do to the guy. Maybe they keep him locked up in a basement room, feed him through a hole in the wall. No. He says, I'm so glad you called. I have all day to answer your questions. I didn't have all day to ask him questions, but I was afraid if I hung up the phone too soon, he'd do something rash. So after what I thought was a polite period of conversation, I said, where do you get these 2/3 and 1/3 weights? 2 minutes of silence. I can hear papers being rustled, terminals being turned off and on. Finally comes back and says, I don't know, it was here when I got here. I said, what? He says, it was hired 2 years ago. It was already here. Don't blame me. I'm not trying to blame anybody. I just want to know where those weights came from. I don't know. Here when I got here. You know how often I've heard those words, here when I got here? You're going to hear them as well. You're going to get on your desk. You're going to see a number pass through, 6.33%. What is that number? Where did that come from? I don't know. It was here when I got here. When did you get here? 1979? You never asked? No, I don't do. I just do my job. I just don't lift up pebbles, rocks, see what's under them. It's amazing how much of finance we've outsourced. I've sat through valuations. You say, where do you get your beta? Barra. Where do you get your risk premium? Duff and Phelps. Where do you get your cash flows? Management. What the hell are you, a concierge? You collect all these numbers, you put them in an Excel spreadsheet, and you tell me you value the company? If we turn over every single number to somebody else and say, hey, I got this from here, I got this from there, then you're not doing valuation. In fact, I'm not sure I need you in the middle. All I need to do is mechanize the process and feed them all in. So I don't care what risk premium you end up using or what beta. The one answer I don't want to hear is, here when I got here. Right? Because that's often the answer is, why do we keep doing things the way we always do? So with that build up, let's talk about why people so hate betas. There is no trigger word more likely to evoke a response among portfolio managers than the word beta. In fact, I've gone to Omaha 4 times in the last 10 years for obvious reasons, right? It's, you know what happens in Omaha every year? It's called Woodstock for value investors. They all gather together and watch an 88-year-old and a 95-year-old chat with each other. I've never actually gone into the meeting, but the portfolio managers gather, they often they're polled to see who would you like to hear from. For whatever reason, they keep calling me back, even though I abuse them every year. They come back again next year. And all I have to say is the word beta, and the room shuts down. Because for value investors, this is not right. You cannot use betas to measure risk. And I understand. In fact, I walk into this process with open eyes. I'm not going to claim that betas are perfect. In fact, they're very imperfect measures of risk. So when somebody says, I don't like betas, and you're going to run into a whole bunch of people who say that, the first question I always ask back is why? So what do you mean why? There are 2 reasons why people dislike the use of betas. The value investor's reason is very simple. They say our job is to estimate intrinsic value. Beta as a measure of risk comes from looking at what? Stock prices. A price-based measure of risk does not make sense in an intrinsic valuation. I understand. That makes sense. So one reason people don't like betas is because they don't like to use price-based measures. The other reason people don't like betas is when I use beta, what am I assuming about investors, at least the marginal investors? They're diversified, right? So the other group of people say, how can you make that assumption? Investors are often not diversified, your marginal investor might not be, so you cannot use betas because it captures only a subset of the risk. You should be looking at total risk. So the 2 reasons people don't like to use betas is first, it's a price-based measure, and the second is that you make this assumption of diversified investors. Okay. If your reason for not liking betas is because that this is a price-based measure, I have, what does beta measure after all? If you boil it down, it measures relative risk, right? So when I say beta is 1.2, I'm saying your stock is 1.2 times more risky than the average stock. You just don't like the way I computed the 1.2. You want something more intrinsic. Okay, let me offer you an alternative. Well, rather than look at stock prices, you're focused on earnings, right? You're a fundamental investor. What if I took your earnings over time and I computed the standard deviation in earnings, how much it varies? A company with stable earnings to you is safer than one with a lot of volatility. What if I computed the standard deviation in earnings for your company to be 25%? And what if I did this for every stock in the market? I can compute the standard deviation in net income or operating income for every company. Let's say the average standard deviation in earnings for a company is 20%. Do you see where I'm going to go next? Your standard deviation in earnings was 25%. The average standard deviation in earnings is 20%. 25 divided by 20 is 1.25. That looks a lot like a beta to me. It's not based on prices. It's based on earnings. You don't like prices. Tell me what you think of as your proxy. What would you like to look at? And I will build a risk measure around it. I want to make it a relative risk measure because otherwise I have these numbers floating around. Standard deviation 25%. There's no way to convert it into a hurdle rate. But if you want to use an intrinsic value, but I'll give you the cautionary note. Earnings might be more fundamental, but what do you give up when you go to earnings? How often do earnings get measured for a company? Not once every day, not once every hour, but once every quarter, if you're lucky. In parts of the world, once. You're saying, so what? Well, if you've been around 4 years, then there are going to be 16 observations in earnings. Talk about the standard error and betas. Those are going to be much greater. And second, who estimates earnings? Accountants do. And accountants have this thing about smoothing things out. And so don't assume that earnings are measuring at the actual performance either. So if you're going to use earnings, at least recognize that this is going to give you its own set of props. But I can compute a relative risk measure built around earnings. If you tell me debt ratios are your proxy for risk, that companies with high debt ratios are riskier, then I'll build a relative risk measure around debt ratios. But if you have a problem with betas because they're price-based, I have counters for you. Yes? Well, see, I wanted to use betas. You were the one who said you wanted to. I'm not going to be the one who picks the fundamental for you. So you tell me what you focus on in valuation. Value investors often are focused on earnings. If you're cash flow based, you might say, I want to focus on cash flows. I'll build something around. So I'm going to turn the onus back on you because it's not fair to tell me that what I'm using is not right and then not tell me what you would use instead. Because then we're in no person's land. So basically so if it's price based, give me what you'd use instead as your intrinsic value measure. So that's if your problem is with it being a price based measure. What's the other argument against betas is maybe investors are not diversified. That makes sense, right? If you're, especially in some parts of the world, Eastern Europe, Africa, parts of Asia, maybe this assumption of marginal investors being diversified is just way too strong. So here's my counter. Rather than use betas, so basically if you look at, did I do the, oh, sorry. So rather than use the beta, which looks at only the portion of the standard deviation, you cannot diversify away. That's what the covariance measures. If you truly believe that investors are not diversified, what should they be looking at? They should be looking at the total variability in the stock price. In fact, if you told me the standard deviation in your stock price is 40%, and the average standard deviation in stock prices for US stocks is 30%, I could divide the 40 by the 30. It looks like a beta again, but now I'm focusing on total standard deviation rather than the portion of the standard deviation. So Valiant, for instance, would have ended up with a high beta because even though its beta was low, the stock price was incredibly volatile. So if your concern with this is that you don't like the diversified investor focus, I can push back. Here's another thing you can try. If you don't like betas because they look at, maybe you can tell me some proxy you'd use instead as your measure of risk. Like what? You could tell me small companies are riskier than large companies. You better have a good basis for this, but if you want to do that, then I can figure out a way to come up with a cost of equity that's higher for small companies and lower for large companies. In fact, much of the work in the last 20 years in finance, because as our access to data is improved, we're now able to say these things matter, these things, so market capitalization, price to book ratios, momentum. I can build regression equations where if you tell me your characteristics as a company, I can come up with a cost of equity and expected return that reflects it. And it doesn't make any assumptions about diversified or undiversified investors. In fact, one of the reasons the CAPM survives is it's adaptable. And what's happened to the CAPM, especially over the last 30 years, is in the traditional CAPM, to get an expected return, I take risk-free rate plus beta times risk premium, and you're done, right? So you know what the CAPM has adapted to do? Basically, you tell me small companies earn higher returns than large companies. You take risk-free rate plus beta times risk premium, then you add a small cap premium, a liquidity premium. It's called the build-up approach. I call it the make-it-up approach as you go along, because you're going to end up with a number you wanted to see in the first place. But you can see the model adapting to bring in things that might capture the risk that a diversified investor will ignore, but other investors are pricing in. So whatever your problem is with betas, I can live with it, because what do I need at the end? I need a cost of equity with a relative risk measure. So if you don't like betas, I will just find a relative risk measure that you can live with and bring it into my hurdle rate. So with accounting risk measures, we talked about earnings, balance sheet ratios. There are even qualitative models where you have numerical scores for companies. I can even live with that. So if you tell me you've classified companies from 1 through 5 based on risk, I'll just come up with cost of equities. I mean, I'm a pragmatist in this. I want a cost of equity. If you cannot live with betas, I'll find a way to get around it, because this should not become the end game for you. And for a lot of people, it does. If you ask in Omaha, for instance, why, you know that most value investors don't actually value companies. They price them. They use multiples, they use screens. And if you ask them, why do you not do discounted cash flow valuation? The number one reason is, I don't like betas. You're throwing the baby out with the bathwater. Beta is a means to an end. Don't let it become a block where you give up the rest of the process, because there's still value in the rest of the process. Okay. So I will use betas for my valuation, but if you feel strongly that this is not the way you want to think about risk, come up with your own proxy for relative risk. Keep moving. Ultimately, you want a hurdle rate, a cost of equity, a cost of capital that you want to build into your valuation. So now let's take a little deeper. When I started this discussion of betas, I said they don't come from Barra, they don't come from Bloomberg, they don't even come from a regression ultimately. They come from choices companies make. So think of these as the fundamentals that determine the beta of a company. And here's what you want to remember. Betas measure risk you cannot diversify away. And if you think about the three choices you make as a company that drive it, the first and the most important choice is the business you choose to be in. Once you make the choice, the die is cast. And here's why. If you produce a product or service that is discretionary, I would expect you to have a higher beta than if you produce a product or service that is non-discretionary. You know what I mean by discretionary, right? If your customers can live without your product, they can delay buying it, they can defer buying it, they will have your company will have a higher beta than if they cannot do that. So let's take a sector where this plays out. Let's take retailing. It's one big sector, right? Let me break retailing down into 4 groups. You have discount retailers, you have special retailers, department stores, and luxury retailers. Given what I just said, if you knew nothing about these companies and asked you which one of these 4 groups should have the highest betas, your answer is going to be luxury retailers, and then as you go down the chain. In fact, if I add grocery stores to this mix, as they're retailing groceries, they would have the lowest betas, right? But to show you even within a business you can have variations, if I took 2 grocery stores, Safeway and Whole Foods, given what we just said about discretionary and non-discretionary, which one should have the higher beta? Let's face it, if you feel really flush with cash, then you want to eat organic stuff because you want to live longer. If you're feeling a little crunch for cash, you're saying, I'm going to die anyway, so I'm not paying 4 times what I normally do for eggplant, so I'm going to buy the inorganic or the pesticide extra eggplant or whatever is cheapest. But even within the business, you can start to see divergences. It's a very simple and powerful way to think about betas. In fact, in economics, I'm measuring the elasticity of demand. The more elastic your demand is for your product, the higher your beta is going to be. There's a reason tobacco companies have really low betas. I'll tell you, cannabis stocks, once they get established, will have low betas. Why? Well, if you're a company and you want a really low beta and you came to me and said, what should I do? My suggestion is try to make your product or service an addiction. Sounds immoral and unethical, but let's face it, Morgan Stanley could addict you to structured products. Would they do it in a second? Absolutely. Every company's dream is to addict you to their products. It just doesn't work as well when it's not an addictive substance. So think about the product or service you have as a company, and already you got the first building block. Let's move to the second building block. Tell me something about your cost structure. The greater the proportion of your costs that are fixed costs, the higher your beta will be as a company. Why is that? What happens when you have a lot of fixed costs? In other words, when you have lots of fixed costs, in bad times, you're going to have horrific earnings. In good times, you're going to have astonishingly high earnings because every additional product you sell is almost pure cash. I describe fixed costs as basically taking a mood swing and making it into a manic depression. Basically, everything gets much wider. That's what fixed costs do too. So within a business, companies with high fixed costs will have higher betas than companies with low fixed costs. But there's only so much room to run. If you're a steel company, you can't make it all variable costs, but you can still make choices that can drive your fixed cost structure. So that's the second stop. Tell me something about your cost structure. And then I'm going to ask you a third question, and this is a self-inflicted wound. When you borrow money, you create a fixed cost you did not have until you borrowed the money, right? What am I talking about? Interest expenses. You got to make it in good times, you got to make it in bad times. By borrowing money, you're making not the business riskier, but the equity in the business riskier, and beta always goes with equity. So the third question I'm going to ask you is, how much have you borrowed? And here I can actually be specific, because if you tell me how much you borrowed, there's a way in which I can take the business risk you have as a company, and we capture that with what's called an unlevered beta, fancy way of saying that's how much business risk, and I'm going to scale it up for how much debt you have. So the more you borrow, the higher your debt to equity ratio. And one thing to remember, in finance, whenever we talk about debt and equity, we're always talking about market values. I'll give you the one exception later on when we talk about book values, but debt to equity ratios, we're talking about what's the market debt, market equity. So the more you borrow, the more risk your equity is exposed to. So what business are you in? How much of your costs are fixed costs? How much have you borrowed? If you can answer those 3 questions, I don't even need to see a regression page. I can pretty much guess what kind of beta you should have, at least in terms of, is it a high beta, an average beta, or a low beta? So in a perfect world, here's how I'd estimate the beta for your company. I'm going to start off with the beta of the business you're in. So if you're an airline, I'd like to know the beta of being in the airline business, which is going to be a function of how cyclical are you, how much do you move with the market, which it's going to capture. Is your product discretionary and non-discretionary? In a perfect world, I'd take that base business beta and reflect your cost choices. Are you a company with a lot of fixed costs or low fixed costs? And I'm going to adjust your business beta for operating leverage. That's what the fixed cost variable cost is called. And as a third step in this process, I'm going to bring in how much you borrowed with the debt to equity ratio and computer levered beta. A business beta corrected for operating leverage, corrected for financial leverage. You'll almost never see adjustments for operating leverage, and you're going to see why when I show you what you have to do to adjust for differences in operating leverage across companies. To adjust for operating leverage, here's what I need to know. I need to know how much of your costs are fixed and how much are variable. You're saying, what's the big deal? Well, if you look at the income statement for a typical company, there's revenues minus cost of goods sold. It doesn't say variable fixed. You could try to make guesses about what's fixed or what's variable. Is SG&A a fixed cost or a variable cost? The reality is accountants don't break costs into fixed or variable. Maybe if all I had to do this was for one company, I might be able to extract the information to do it. But if I wanted to say whether your cost structure is higher or lower than the typical company in the sector, I now need to do this for every single airline. So you can see that the problem with fixed cost and variable cost, the reason we don't adjust for it is not because we don't know how. We know exactly what we need to do. The fixed costs become the numerator, the variable costs become the denominator. So if I can get this for every company, I can adjust the beta for a company for its fixed cost structure. In the real world, getting those numbers is close to impossible. So here's what we do. We wave our hands. We say, if you're a steel company, your operating leverage is probably like that of a typical steel company, and most of the time you're going to be able to get away with it. If you're an airline, your cost structure is going to look like that of a typical airline, but you see the exception there? When will this get you into trouble? Which of the airlines do you think this is going to get you into trouble, this assumption? Well, Southwest and the airlines that came out of it, because Southwest was built on a structure of keeping fixed costs low. Starting with the type of aircraft they used. They used a 737 and every single, because it kept their maintenance costs much lower. They flew into no-name airports because they didn't want to pay for those gates and Heathrow and Newark and JFK. Right from the beginning, they don't have business class seats. Why? Because it is, again, a discretionary product. I mean, I remember in 1999, I would fly British Airways, and half the plane was business class. Why? Because they were making a lot of money in business class. It looked good until it didn't. Because after 9/11, guess who felt the pain the most? The airlines that had converted the most to business class, that got the most upside, were now sitting there with these expensive half-full planes where nobody would pay $8,000 to fly to London and back. Every decision Southwest makes has always been attuned to keeping cost structures low, which means holding all else constant. I'd expect Southwest to have a lower beta than a typical airline. But for most sectors or most companies, you can probably get away with the assumption if you're a steel company, your operating leverage is that of a steel company. But if you're pushed on why you're not adjusting for fixed costs and variable costs, turn the problem back on the person who's doing the pushing. Say, okay, why don't you go collect fixed costs and variable costs for all 20 companies in the sector, and I'll adjust for them. The critique will stop almost right away because it's not easy to do and people will give up. Now for operating leverage though, the adjustment is much simpler. And here you can observe debt and equity. Though even there with debt, I'm going to talk about what's messed up in debt calculations. But here, the debt and equity, if it's observable, can be adjusted for. The conventional way of adjusting for this is through with an equation that's been around 35 years. It's called the Hamada equation for betas. And here's what it starts with. It starts with the unlevered beta, which basically captures the business you're in your operating leverage. It measures how much you borrow with the debt to equity ratio. It adjusts it for the fact that interest is tax deductible, saying it's a fixed cost, but you get this partial protection because the government gives you a tax deduction for interest. And it estimates a beta for your equity based on your debt to equity ratio. But it has one flaw that some people find fatal. It assumes that the beta of debt is zero. It assumes that all of the market risk in a company is borne by, it doesn't assume default risk is zero, but it assumes that if there's market risk, equity investors bear it. Why? Because it makes the calculation a lot simpler. But it is unrealistic, and here's when. When you get to be a triple C, if you're in the high yield bond market, look at what drives high yield bonds. High yield bonds are often driven by the same things that drive equity, because you're no longer buying a conventional bond. So you could argue that especially as you get to single B, triple C, double C, your debt has market risk and there should be a beta attached to it. So again, you're going to get pushback from people saying, hey, you know what, this levered beta formula that you're using assumes a zero beta for debt. That's unrealistic. Agree with them. Okay, it's unrealistic. There's a way in which I can bring in the beta of debt if you can estimate a beta for debt. So if you can estimate a beta for debt, I can actually adjust this equation. You'll almost never see people doing it because very quickly they're going to run into estimation issues of how do I get a beta for debt. But if you can estimate a beta for debt, I can then parcel the market risk out between. Basically what I'm doing is I'm saying bondholders and lenders now bear some of the market risk. The beta of equity is going to be therefore lower because of that sharing. So if you can get a beta for debt, and actually I have a table in my book on where I've computed a beta for debt based on rating. So if you're a triple C rated company, the beta of debt is like 0.4. If you're single B, it's like 0.3. And as you get closer and closer to triple B, it starts to get closer and closer to zero. And the traditional equation holds. What I'm trying to say is, again, people pick on the weakest link in your equation, and what they want you to do is not do it at all. That's not an option. So if you want to make a big deal about operating leverage, I'll go along with you, but you better go along with me and do some of the work with me, because I'm not going to collect fixed costs and variable costs because I'm not that concerned. You're the one who's concerned. And the same thing applies with levered betas. You don't like the old-fashioned equation because it makes unrealistic assumptions about the beta of debt. Not a big deal if you're willing to then go along with me, try to estimate a beta for debt. Okay. So here's my alternative to regression betas. Rather than focus on a regression beta, here's what I'm going to do instead. I'm going to start with the business or businesses your company operates in. So let's say you have a company and you want me to estimate a beta. I'm going to come and ask you, what business or businesses are you in? So let's play along. Let's assume you're in two businesses, steel and software. Strange combination, but it's your company. I say, I'll be back tomorrow. Here's what I do. I go back to my office and I find as many publicly traded steel companies as I can and as many publicly traded software companies as I can. Let's say I find 100 steel companies and 100 software companies. They're publicly traded, so what can I look up for each of them? I can look up a regression beta for each of them. So I find 100 steel company betas, 100 software. I take a simple average. Hang in there with me, because he said, we're getting away from regression betas. So I take the average regression beta across 100 steel companies, average regression beta across 100 software companies. But we said regression betas reflect both the business choices you made and the debt to equity ratio you had as a companies, right? So what I'm going to do is I'm going to clean up those betas for your leverage choices. It's called unlevering a beta. It's just basically the algebra of reversing the process and computing what the beta for your business would have been if you had no debt. I'm going to now end up with an unlevered beta for being in the steel business and unlevered beta for being in the software business. I come back to you. Say, told me you were in two businesses. How much of your value do you get from each business? And your reaction might be, I don't know how much value I get, but I get 70% of my revenues from steel and 30% from software. It's okay. So what do I do next? I take a weighted average. I take the unlevered beta for steel times 0.7, the unlevered beta for software times 0.3. I now have an unlevered beta for your company. What's the last question I'm going to ask you? Do you have any debt? And if you say no, I'm done. Because this unlevered beta becomes your beta for equity. If you do have debt, I'm going to compute the debt to equity ratio and compute a levered beta. Now why am I doing all of this? Because I don't like regression betas, right? But I started with regression betas. So what's the big savings? What is the advantage of using an average of 100 regression betas instead of one regression beta? Come on, think back to your statistics class. It's called the law of large numbers. Put crudely, here's what it says. You can take 100 crappy numbers, put them in a pot, stir them up, and pull the average out. The average is magically precise. I never got this in my statistics class. How can the average of 100 crappy numbers be good? I think I get it now. When I showed you the GoPro beta, and you saw that big standard error, what is it telling you? That the beta might be too high, Too low. So when you have a big standard error, some of your betas are way too high, some of your betas are way too low, right? When I average out, what happens to those mistakes? They start to disappear because I'm averaging some betas which are too high. It's a pure statistical rationale for why. In fact, I'll tell you how much more precise an average of 100 betas is going to be than one beta. So one of you can help me. How much more precise is an average of 100 betas going to be than one regression beta? It's going to be 10 times more precise. You know how I came up with the 10? I just made it up? No, actually I didn't. I took the square root of 100. If I have 600 companies in my sample, guess what? I get almost perfect betas because I'm averaging across lots of numbers. You say, what if I have only 4 companies? It's still better than 1. Anything beats 1. That's what you have. You have a sample size of 1 right now. I can beat that. And with 43,000 companies, here's the one thing I don't want to hear from you. I have a company that's so unique, I cannot find any other companies just like it. There is 0 chance of that happening unless you've defined your business so narrowly. I'll give you my favorite story. It's from a Chilean business person who he emails me after looking at it. He said, I was looking at your, because I report betas by industry on my website. He said, I was looking at your beta list. I could not find my industry. I says, okay. So what does your company do? It's in scallop fishing. I said, okay, what are you looking for? He said, I was looking for scallop fishing as one of the... And I didn't want to be difficult. I said, what exactly do people do with scallops? He said, they eat them. I said, do they eat other stuff as well? I said, I guess so. I said, why don't you just look at food processing? What's so special about scallops? He said, but scallops are different. Maybe you're too close to the scallops. Maybe they smell bad. But they're food. So when you define, if you don't have enough companies, either define your business more broadly or go global. You know what I mean by global? You go back, let's say you end up in Portugal. Well, you're an equity research analyst in Lisbon. And you say, I'm going to look at a Portuguese consumer product company and I'm going to look at other companies in the same market. You're not going to find very many. There are like 90 companies in the entire market. You have 43,000 other companies. Can I compare betas across markets? Why not? What's the average beta across all US stocks? Play along. It's 1. What's the average beta across all African stocks? It's 1. What's the average? The nice thing about betas is there's nothing that stops you from globally stretching your sample. That's the nice thing about S&P Capital IQ is when you screen for your stocks, initially you can start by screening only in your market and with a very narrow definition of industry. You can even add other criteria. I want only big chemical companies in the US. And if you find 15, you're home free. Keep going. Move on. But if you find 3, initially you might say, I'm going to relax that market cap screen, and then you can relax the US screen. You can always find companies as you sit there and broaden your definition because you are looking for the law of large numbers to work for you. So, yes, go ahead.
Does it matter if you look for sample companies specifically in that industry or they just have...
I'll give you my generic definition for what a comparable company is. A comparable company to me is one that does well when I do well and does badly when I do badly. Notice there's nothing even sector specific in that statement. If I'm a movie production company, I do only as well as the movie companies do, but I might look at Netflix because in a sense, we're all connected in terms of how our businesses do. So if you define comparable as, I want companies that do well when I do well and do badly when I do badly, you might actually be stretching across sectors looking at companies. So it gives you a lot more freedom in defining comparable rather than stay focused on an industry grouping that might no longer make sense. So the biggest pitch I would make for bottom-up betas is they're more precise. But here's the added benefit. Remember we talked about business mix. If you asked me to compute a beta for GE, I sent you my GE valuation last week, right? If you asked me to revalue GE today, could I recompute the beta for GE? Absolutely, because all I need to do is compute the new beta based on the businesses they're in today. If they enter a new business tomorrow, I can bring that in too. I retain the flexibility now to adjust the betas for what your company does. Yes?
You weighted the betas by revenues. Shouldn't you do it by earnings?
I haven't weighted by anything yet.
No, earlier you just said, right, 70%.
Oh yeah, I said I stopped there. But when you see the beta, I'm not going to use revenue. So basically, so The bottom-up beta's strongest point is you can get a more precise beta, you can get a company beta that reflects the company, and here's the added benefit. Like Airbnb and Uber will probably go public sometime this year. Let's say you wanted to value. You know, and I'm hoping that Uber goes public this year because I'm going to value the IPO right after the process. It'll be the first time I've ever seen Uber's full financials. I've been valuing this company 5 years with 3 or 4 numbers every year because they're remarkably cagey about what they've revealed. So I just can't wait to get my hands on those prospectus. But let's say I want to value Uber based on a prospectus, and I go to Bloomberg and try to find a beta for Uber because that's the only way. Let's say that's the only way I know how to estimate betas is run a regression. What am I going to find? Nothing. It's a private company. You now have the capacity to value private companies or divisions of companies. If GE called you and said, value Danaher because that's a division that they're selling, you're not going to find a beta for Danaher standing alone. It's always been part of GE. We now have a way of getting betas for private companies, divisions of companies. Essentially, you can value just about anything. So now let me take the point about how do you weight these businesses. I use revenues because that's obviously a number that most companies will give you. But in theory, what you want for betas are value weights. So if I can somehow convert the revenues you get in each business into estimated values, that would be a better way of weighting. So I'm going to take as an example Vale, Brazilian iron ore mining company, breaks itself down into 4 businesses. Metals and mining, iron ore, fertilizers, logistics. I went looking for publicly traded companies in each business, and I didn't stay Brazil focused because this is a global company. I don't even see the point of being Brazil focused. So every one of the samples, I looked at global companies. Take a look at the sample size. For global specialty chemical companies, I have 683 companies in my sample. The law of large numbers is working big time in my favor. So I went and looked at publicly traded companies in each business, got the unlevered beta. And then I wanted weights for the 4 businesses. Vale just gave me revenues by business. So if you look at the 4th from the last column, they gave me revenues by business. If I can somehow convert those revenues into values, I can use those as weights, right? Now remember those publicly traded companies I used to get the betas? I also collected one other statistic on those companies. I looked at what their enterprise value, which is the market value of a company divided by the revenues. What multiple of revenues companies in logistics or companies in metals and mining were trading at. So let's take an example. The typical metals and mining company trades at about 1.97 times revenues. The typical iron ore mining company trades at about 2.5 times revenues. Do you see where I'm going to go next? I took Vale's revenues by business and applied this. It's a very simple pricing of the businesses. You're saying, but we're doing intrinsic valuation. This is just a stop on my intrinsic valuation. I'm not going to stop here and tell you this is the value of the company. But the weights I got based on those estimated values are 76% iron ore mining, about 17% metals and mining, about 5% fertilizers, and less than 2% logistics. Just make sure the weights all add up to 100%. That's a one requirement that you cannot break. But if the weights add up to 100%, your weighted average across those businesses will now be the beta for Vale's operations. And if you ask me what the beta then is for Vale as a company, I'm going to apply Vale's debt to equity ratio to that beta. And the levered beta I end up with for Vale is 1.15. And that's not a beta that comes from a regression, it's the bottom of beta. But here's the added bonus. If you now say you're planning to sell off the logistics business, which Vale did shortly after this, and you say, what beta should I use for the logistics business? I'm going to estimate a beta for the logistics business of 1.02, different from the beta of the company because it has a different risk profile. So if you take a look at the GE valuation that I sent last week, which is a little unfair because I had all these breakdowns, it's in if you look at the business breakdown, you'll notice the cost of capital is different for each business. The way I got cost of capital for each business is I computed a beta for each business and built up to a cost of capital, which then gives me a much more nuanced way of saying, this is the discount rate I would use to value this specific business. One more bottom-up beta, and then we can kind of close the book. Let's take Embraer, Brazilian aerospace company. If I define my comparable companies as other Brazilian aerospace companies, I end up with a sample size of 1. And it's Embraer. That doesn't help me. If I make it Latin American aerospace companies, I end up with still a sample of 1. So with Embraer, I went global. My sample included Bombardier, Boeing, You're saying you can't do that. They're developed market companies. Beta doesn't carry the burden of emerging market risk. Even if I give Embraer the same beta as Boeing, what do I multiply the beta by? The equity risk premium. So if you're concerned about country risk, don't expect the beta to be higher for that company. The equity risk premium has the burden of carrying that. So I have absolutely no qualms about using global averages, global betas to compute the betas for individual companies, with one exception. When we say drives beta, what's the first choice you make as a company that determines your beta? How discretionary is your product or service, right? There are some sectors where this can come into play. Take telecom. In much of the developed world, telecom is not a discretionary product. Everybody has to have telecom service. It's kind of almost a God-given right. In fact, in the US, it might be illegal. If you don't have a phone, the phone company has to give you a phone to call 911 if there's an emergency. Much of the world, though, that's not true. It's starting to change, but basically, in much of the world, telecom service is a discretionary service. If the country does well, you're going to see not just people with more phones, but more services on those phones. Do you see where I'm going? If you ask me the beta that I would use for Reliance Jio, I was going to use the other Reliance Telecom, but that's, I think, bankrupt already, so I don't even know where to go with that. Rather than look at global telecom companies, I might look at just emerging market telecom companies. And that's part of the reason. If you look at my website, I have betas for US companies, global companies, emerging market companies, because I want to give you that choice. Maybe there are some sectors that are regulated in Europe and not in the rest of the world, and there you might want to use betas just for the reason. So I'm not going to blindly use global wherever I have global data. Sometimes I might make a choice that leads me to a different answer. One final page and then we'll be done. The debt to equity ratios that I use are gross debt, total debt, divided by market equity. In much of Europe and Latin America, the practice is to use what's called net debt. You know what net debt is? You net cash out against it. And often I get asked questions, is it okay to use net debt to equity? The answer is absolutely, as long as you stay consistent all the way through. If I took Embraer, for instance, with a gross debt to equity ratio, I get a beta of 1.07. That's a beta that I used. But if you use a net debt to equity ratio, you actually get a negative net debt. How does it happen? If your cash balance is greater than your debt, your net debt can be negative. Don't mess with that number and say it can't be lower than zero. It can be lower than zero. Use the negative net debt to equity ratio, and the levered beta that I get for Embraer using a net debt to equity is actually lower than the unlevered beta. You're saying, will this not give me a lower cost of equity? Yes, but that's not my end game. What do I go towards? I want to get to a cost of capital, right? And if you work this all the way through and use a negative debt ratio in your cost of capital, you're actually going to end up with a cost of capital very close to mine if I use a gross. Try it out. Take a company, work out the cost of capital with gross debt to equity ratios, then work it out with net numbers, and you're going to find that the answer you get is very close with the two as long as you stay consistent. So when we start in the next session, we're going to start with the cost of debt and pretty much finish the discount rate part and move into cash flow. So I will see you soon.
In the newsletter, you asked for the market risk premium. Does that actually mean
Equity risk.
accurate?
Yeah. Yeah, it's exactly what it is, a cash flow based IRR.
But exactly, so like for long-term investors and
That's what the terminal value captures. It's price appreciation. You look at the terminal value, the last term in the equation, that's actually the value of the S&P fund at the end of year 5. And that's going to be the price appreciation portion already. So but you can't have your cake and eat it too. If you sold your stock in year 1, you're not going to, so you collect only the cash flows for the first 5 years. At the end of the 5th year, the terminal value captures the price appreciation. It basically assumes that if there's price appreciation, it comes from the cash flows. No, beyond the 5th year, right? Because if you look at the terminal value, it's going to be the cash flow in year 6, which is a function of your growth. So everything you put in, the base year cash flow, the growth rate, all go to the terminal value. But that captures what you think you're going to get as price appreciation.
So, but like in the next, okay, so in the long
In the next 5 years, you can't have price appreciation because price appreciation means you're selling your stocks. If you sell your stocks, you can't get the cash flow in the next year, right? So if I'm letting you collect the cash flows, you can't be selling the stock. And so that's why you collect only cash flows. There's no price appreciation because price appreciation is not a cash flow. It's kind of in there, but you collect the price appreciation to determine the value.
and also one, you said like if your market was like you wouldn't use it as experience.
You probably move to a global index for everybody. So BlackRock, for instance, probably should be using a global index for all data. It's not going to give you an answer that different from an S&P 500 because in dollar value terms, the U.S. stocks is still 43% or 42% of the global index. But a global index is probably what you're going to move towards.
But if you're handling the cost effectively, and as you said towards the end of the lecture, like if you have a low data because it's priced out, but you will still have a high technology, so wouldn't that kind of protect?
No, because in a sense, a Helsinki beta, well, why are you expecting you to have a high risk premium? It's a Finnish stock. No, there's no risk there. It's a AAA rated country. So you're asking something to bear the cost of, but, so I think you've got to be explicit about betas capturing business risk rather than let the index drive what that number ends up being.
Right. So, but then wouldn't everyone have like a different like cost effectively compared to like how like where your stocks are?
Well, you were saying different investors will have different indices. You're right, but there's a marginal investor. If you're investing in a stock where BlackRock is also investing, guess what? What you think about marginal investing doesn't really matter because they're the ones setting prices. And that's the essence of marginal investing is the rest of us have to be price takers. And we live in a world where the marginal investors are all becoming global institutional investors. For better or worse, you and I can sit there saying, I own only Indian stocks. I'm going to estimate. You can do whatever you want, but the pricing of those stocks is going to reflect what those marginal investors think about the stock. So, unfortunately, it's true. Our perceptions might be different, but they don't really matter in the valuation because the marginal investor drives the risk.
90% is held by them.
It's not even that. 90% of the trading is done by them. They don't even have to hold 90%, right? If they do the bulk of the trading, so